This is a brand new paper. We literally just circulated the draft a week ago. It's a very interesting time to be thinking about large language models. A lot of the discussion is around AI, and I think a lot of the sort of most recent discussion is around agent-based systems. This is actually a paper that's trying to go back to the more pure machine learning aspects of how LLMs can be usable, right? So this, I sort of feel like, is an old style stock anomaly paper. It's a very strong empirical fact, though. It's a nice, clean empirical analysis for a 20-minute session. All right, so let's get into how this works. All right, so the basic organizing question, if you like, is how does the market assimilate information in news media? All right. The way we're going to approach this problem is with large language models and the embeddings of the text that live internal to those language models. All right, so you can think about the basic framework that we're going to employ here. So we're going to go to the guts of the language model, look at the numerical representation of raw text that shows up inside those models, extract them, and then use them in otherwise standard machine learning asset pricing analysis. All right, so just to understand where this kind of lives in this landscape of AI, we are going to be working with some of the state-of-the-art or near state-of-the-art models. Will talked a little bit earlier about Mistral. We're actually going to be spending a lot of time talking about Mistral here. But we are not working with the prompt functionality, okay? We are working with, in essence, something that looks like the predecessor of the word prediction functionality. All right, so if you think about how a language model works, it's a function that ingests sequences of text and typically outputs some predicted token, some predicted word, right? It's nice for an audience like this because then we can recognize that LLMs are not just performing magic in the background, they're doing something that looks like sequence or time series-esque modeling. For the purposes of what we do here, you can just think about a language model as a function that eats words on one side and somewhere in this digestion process produces a compact vector representation of those words. It is the internal language of the language model. It is the computer language of the language model. It's a numerical vector representation, and it really is at its essence a compression, right? We have raw text, and we're trying to represent that text in an efficient numerical representation. All right, we're going to call that an embedding. Rob's going to talk about embeddings in a little bit of a different sort, but very generally, an embedding is just that. It's a compact representation of some data object. All right, so that's going to be the data that we're working with here. And the particular model that I'm working with is going to be this Mistral embedding model. So it's a 7 billion parameter model. It's exactly one of the models that Will was referring to earlier. All right, so let me give you a little bit more detail on what the data structure looks like, because one of the beautiful things about working with text embeddings in otherwise standard asset pricing analyses is that it organizes your data in a very clean way that looks like a lot of the numerical data sets that we've been using for decades in finance. All right, so let's not worry too much about the detailed text in between here, but let's just think about how I'm producing a data set. My ultimate goal is to do something that looks like traditional asset pricing analysis, right? So I want to take in some data and I want to produce a portfolio that comes out the other end. The way we usually do this is we collect some stock attribute, right? Typical stock attributes that people like to look at are things like book to market ratios, momentum, accruals. You can name lots of different numerical measures. I actually like to think about all of those as an embedding of an asset itself, right? A vector of characteristics about a stock is actually a brief numerical summary about the identity of that asset. So we've in some sense been doing a lot of this type of analysis in asset pricing for a long time. The typical data sets that we work with look rectangular in nature then, right? We have rows of our data sets that look like stock month observations, and then columns which are just different asset attributes. Very clean tabular data sets for us to work with, and it's traditional econometrics that we're able to apply here. All right. We can do the exact same thing with text data. Text data seems like it'd be so much harder to work with because of its unstructured nature. But by taking this embedding-based approach, we're actually going to build a very structured data set that looks like traditional asset pricing data sets. So here's how it works. All right. I'm going to be working off of a particular data set of newswire articles. All right. So for every month, for every stock, I have a collection of articles that gets published. All right. I'm going to use my language model to produce one embedding vector. That's a list of about 4,000 numbers. That's how this particular model likes to compress the information in text. So for every article, I'm going to get one 4,000 dimensional vector out. I might have 200 articles in a month for one particular firm. I'll just take an average of those embeddings. All right. So I'm kind of trying to compress information across many articles even further. But by the time I aggregate all of these vector representations of words, I have a stock month observation. Call it EIT, the embedding of news about stock I in month T. It's a fixed length vector. I have one of these for every single stock. I am now back to a nice rectangular data set. Rows are stock month observations, and columns now are something that I can't really interpret well, but they're just some attribute of the information that's contained in the articles about these stocks. All right. That's my data. Once I have this data in place, I can now go to start thinking about how do I build portfolios, how do I use this data to predict returns, and so on and so forth. So there's actually a predecessor paper that I wrote with my close collaborator, Da-Cheng Xu, earlier work, where we just said, let's take stock embeddings, right? So these are embeddings of news organized on this kind of month stock grid. And let me just forecast future returns based on these. And it turns out that you can extract a lot of predictive information for future returns, where prices are going to go based on the news that you see today, right? So in monthly organizations like this, you can typically find some reasonably significant forward-looking predictability about where the price is going to go based on the news that you've captured in these embeddings today. All right, now in that earlier work, what we found was that this predictability actually dies out pretty quickly. It's strong at short horizons, but then eventually the market sort of metabolizes that information quite efficiently. So it seems like the gains from predictability die out even after a couple of days. All right, so that was the first version of this paper. We wrote this original embeddings-based prediction paper around 2021. So this is a follow-on paper for that. So what we point out in this paper is that news itself is highly predictable. So the early paper was talking about using news to forecast stock returns. But the news itself is not really news. Some of it's news, but some of it is stuff that we kind of knew was going to be talked about, right? So you can think about the hypotheses in this paper as being things like, well, I bet that substantial content of financial news is predictable ahead of time. So for example, if there's an article that comes out about a tech stock, I can make a good probabilistic assessment that there's going to be discussion of computer hardware or software or something like that. It's going to be a higher probability that type of word shows up in an article about a tech stock than, let's say, an industrial stock. This is predictability. This is predictability in news. It's just a really simple statement that not all news is news. All right. Well, if not all news is news, then I want to think about how the truly innovative components of news interact with the stock market. Because we think that if it's some portion of the information in news that the world already knew about, it's probably likely to be already incorporated in prices pretty well. It's almost as though I have an errors and variables type of problem. My news has both old news, which is not too likely to be predictive, and new news, which is more likely to be predictive. So this is essentially what we're going to pursue here. We're going to investigate how predictable is news. News is significantly predictable. And then if I purge that old news component from these embeddings that I've built, and I look at the innovation or the shock, the pure news, the true news, you're going to see the predictability becomes sort of stronger than I even expected it was going to become. All right, so let's just look at what this kind of shapes out to empirically. A little bit of notation as I go. So when I predict news, I told you these embeddings I'm denoting by this capital E. The other existing information I have about stocks, I'm just going to put in a data matrix called S. Think of this as standard asset characteristics, things like book to market ratios. Right? This residual epsilon is going to be the news shock, the pure news. It's what's left over after I control for the predictable components of news and observable data that I already have at my disposal. All right. So really what I want to do is I want to move from thinking about prediction based on this big E to prediction based on this epsilon, the innovation in news. All right. So how much news is predictable? I'm not going to go into this in a lot of detail given the brevity of this talk. But the basic statement is that I can predict about 10% of the variation in news using standard stock attributes. You tell me what industry a company is in, you tell me its book to market ratio, you tell me its quality metrics. I can explain about 10% of the variation in the text that we're going to see for those assets. All right. Now, 10% of variation doesn't sound like a lot, but it's certainly enough to start to obscure the more meaningful predictive signal that might lie in that news. All right, so what I'm going to do is I'm going to move now from that raw news embedding, the capital E, and start investigating the predictability associated with the leftover component, the residual, the epsilon, right, which we call in the paper pure news or news shocks. All right, so news shocks and return predictability. What does this look like? Well, one tricky thing that we have to deal with when we're thinking about information represented as an embedding is that these embeddings are high dimensional. Most of traditional asset pricing has pursued predictability at the stock level with sorts. A sort is a good thing if you have one metric that you're looking at. Then I can do a sort, maybe two. If I have 4,000 attributes, we're not going to be sorting anymore. But we don't have to be sorting. Sorting was just a shortcut that people like Fama liked to use to illustrate some points. Nobody thought those were good econometric models. So instead, what we're going to do is we're just going to write a direct econometric model that parameterizes portfolio weights as a function of these embedding vectors, these residual embedding vectors. All right, again, we're not going to go into a whole lot of detail here, but just have in the back of your mind, if you have a high dimensional representation of information, you can convert that directly into portfolio weights via some model, and I can end up with a single portfolio that describes how much predictability is in a particular data set that I've used to build that portfolio. All right, now I'm going to show you a couple portfolios. The ones that I'm going to focus on are something that I'll call the raw news portfolio that has this E subscript, something that I call the predictable news or the old news portfolio, which I denote with this E given other observables. And then this is the one that I really am interested in, the news shock or the pure news portfolio. So I'm just going to show you if I build a portfolio using the raw news, if I build a portfolio using the unexpected news, what is the difference in the performance of these portfolios? That's really the core research question that we're looking at here. And this is the answer. Again, a lot of information on this slide. In the interest of time, let's just focus on these bars here. All right, so what are these bars? These bars tell you the out-of-sample Sharpe ratio from trading on old news that's associated with other stock characteristics that we're aware of, versus trading on the news shock. All right, now what are those stock characteristics that I'm using to purge old news from my news data? There are these JKP characteristics that I built together with Lasse Petersen and Thijs Jensen. It's like 150 different standard stock characteristics. It's not the important point. The important point is, of course, a lot of stock characteristics that people have studied are useful predictors of returns too, which is why you see something like a 0.5 Sharpe ratio, even in the old predictable news, because it's associated with other things that we think predict returns. But those are much, much weaker predictors of future stock returns than these news innovations. So we can see something like there is a really strange degree of predictability in stock prices when I focus on the news shock. The Sharpe ratio from building a portfolio that's asking what happened in the news today, use that information to trade and hold those positions going forward 1 month, you can produce something with a gross Sharpe ratio on the order of 3. Right? So in the world of anomalies, if you go back for the past 50 years in the asset pricing literature and think about the distribution of anomalies, this is what the Sharpe ratios of those anomalies look like. Right? Some of the highest performing anomalies in the past have Sharpe ratios on the order of 1. All we're doing is we're using a new data set, a new information source to ask whether or not there's an inefficient pricing of that information in the market. And we're seeing a result that puts the anomaly performance somewhere out here. So this is the entire point of the paper, is that we spent a lot of time thinking about the nature of inefficiencies in financial markets. By taking advantage of the very, very effective assimilation of news, summarization of news that exists in the machinery of a large language model, we can capture predictive information at a much deeper granularity. That predictive information reveals an inefficiency that seems to dwarf the inefficiencies that we've seen in other anomalies that people have studied for a very long time in the literature. Right? This green bar here, by the way, is to say there are a lot of different anomalies from a lot of different data sets that people have looked at. What if I tried to put all of those anomalies together in a single mean variance efficient portfolio? Well, there's a lot of heterogeneity in the behavior of these anomalies. A mean variance efficient combination of them is actually quite powerful because there's diversification benefits. You can produce something like a 2.2 Sharpe ratio if you combine them all together. That's like several different data sets producing all of these anomalies. One data set alone, news media, newswire text, exceeds the total predictive content of all of these other anomalies combined. All right, the rest of the talk, and I'm not sure where I am on time. Great. The rest of the talk is just about some of the robustness of this. All right, so here's an example of one type of robustness you might be interested in. Right away, we start thinking when we're looking at inefficiencies, we've seen so many times in the literature that inefficiencies are captured primarily in small illiquid stocks. So let me just strip things out. I'll put small and illiquid stocks in the bottom, big liquid stocks in the top. Okay, so everything in the top, these are things above the 60th percentile of the NYSE market cap distribution. These are very liquid stocks up here. It is absolutely the case that when I look at liquid stocks, the Sharpe ratio of the news anomaly is much smaller. It drops to about 1.5. Large stocks are more efficient. But I can also redesign all of those anomaly strategies using the exact same subsample of large stocks. And it's not just the news anomaly that gets smaller when you look at large stocks, it's the entire distribution of anomalies. So again, the relative exceedance, the relative excess predictability coming from news in relative terms is not too different in large stocks versus small stocks. The magnitudes are different because they're different liquidity, right? They're different efficiency across these markets, but the relative performance is very similar. Another interesting question is about the longevity of this effect. So one thing that I showed at the beginning is that when I look at the raw news-based predictability, so going back to that 2021 paper, showed you that the predictability was strong at first, but then it died out within a couple days. Right? When you purge old news from those raw embeddings, you actually see now that the predictability is extremely long-lived. It takes almost 2 years for this predictability to revert to being insignificant. All right. So a way to think about this is it's not just that the magnitude of the anomaly is large. It's actually the duration of the anomaly is also unusually large. And the way that we can see this is we can ask, what if I held this trading strategy not just for 1 month, but for 1 year? I can do that both for the news anomaly and for all of the other anomalies that have been published. Most anomalies revert pretty quickly. So this anomaly is unusual both in terms of its magnitude and its duration. Here's another robustness type of analysis, if you will. Certainly if you're trading on news, And certainly if you're trading on the innovation in news, you're going to be very likely to trade quickly. So let's think about the turnover of this trading strategy. It turns out that the news shock portfolio actually has higher turnover than all of the other anomalies that we've looked at in the literature. So it's going to be very important to think about the cost of trading this anomaly. All right, well, after we do cost adjustments, so now I'm not looking at gross Sharpe ratio anymore. I'm looking at net of trading cost Sharpe ratio. Yes, that pulls the distribution closer to the news shock anomaly, but even after accounting for costs, this looks like a severe inefficiency. And of course, that's if I didn't do anything to try and make the trading costs lower in some way. For example, smoothing the information to pull down the turnover. Well, if I smooth the information to pull down the turnover, the relative performance looks large again. All right. Now, there's some kind of, I guess, zeitgeist in the literature about this worry about point in time versus ex post trained large language models. Do these language models have a lot of look-ahead bias built into them? I'm not going to go into it in detail, but that's not at all about what's happening here. Whether I use the model that was trained at the end of our sample or use point in time recursively trained large language models, the result's identical. This is not about leakage or look-ahead bias within the large language model. All right. Lastly, I was showing you the result for Mistral, 7 billion model. We have a lot of language models out there. So I wanted to look across a sequence of models with increasing sophistication, right? So the simplest model we look at is an embedding from BERT. BERT's the simplest because it's a 100 million parameter model. Its architecture is also a little bit more simplistic, but the main simplicity is that it only uses 100 million parameters. As I go to models like early versions of GPT with 1.5 billion, Mistral with 7 billion, and then we hit the suite of Llama models where we can get up to 400 billion parameters. Bigger models, the more we can make use of that news data. All right. We have a lot in this paper about trying to interpret the behavioral underpinnings of where this inefficiency comes from. That's an entirely separate talk. So I'll just wrap up with stock prices don't incorporate news efficiently. This is a large effect. It's a long-lived effect. It looks like it's bigger than essentially every other anomaly that we've seen in the literature. It comes from sort of revealing the news innovation by controlling for the other aspects of the news that are predictable. The economic mechanisms, there's still plenty more work to be done there. So I'll stop there. Thanks very much.
I'm going to switch this. Just click through. Oh. Okay, thanks a lot for having me. Thanks to the organizers. This is a very convenient ordering of presentations here because Bryan gave you a nice introduction to the concept of embeddings. This paper is on asset embeddings. It's with Xavier Gabaix, Ralph Koijen, and Yogo. So let me just give a little bit of motivation. So in economics and finance broadly, we're often interested in identifying similar firms. Bryan mentioned this. Often what we do is we go and we take observable characteristics and say you look for firms that have similar growth rates or any of these variables in the Crispin CompuStat data. And we say, okay, these firms have similar characteristics and therefore these are similar firms. We can also use things like SIC codes, form industries, and look at similar firms in that way. These characteristics turn out to be far from perfect. In particular, standardized accounting data are an incomplete summary of very often things that investors care quite a bit about. A classic example would be Netflix. When investors are looking at Netflix, what's one of the core metrics that they look at? They look at subscriber growth. That's not going to be something that you immediately are going to be pulling off of the accounting data and these sorts of things. It is in other sources, but investors care a lot about this sort of thing when they form their portfolios. Similarly, new economic environments call for new characteristics. When COVID came around, Zoom had very high exposure to COVID in a very good way. Airlines had very bad exposure to COVID, but that was not something that is in our standard characteristics. On the other hand, investors care substantially about this sort of characteristic of firms. Our central idea here is going to be to actually learn a set of embeddings from investors' portfolios. The novel thing here is not necessarily to introduce this idea of embeddings, exactly what Bryan said. We do embeddings all of the time when we think about measuring characteristics. The idea here is that we want to learn embeddings from a particular source of data, and in particular, learn these embeddings from investors' portfolios. So let me just give a quick rundown through this because we just saw text embeddings. What is an embedding? It's a representation of something. In particular, it comes from the natural language processing literature originally, where we represent words in some high-dimensional vector space. Now, this is the central underpinning of all of the large language models. Bryan just covered some of this for us. The nice thing about these embeddings is they often have some nice structure to them. From a very famous paper called the Word-to-Vec paper, you can take the embedding, this high-dimensional representation for Paris, subtract off France, add back Spain, and then find the word that has the embedding that is closest in that space of that linear combination of these other words. And you'll find for certain models in particular that Madrid ends up being very close to that linear combination of those embeddings. As I mentioned, the core thing in the natural language processing literature is that we learn these embeddings. We don't pre-specify that dimension 1 of this is city, dimension 2 of this is country, right? We learn that representation from a huge amount of data. In particular, these days, we learn it from the entire corpus of the internet and every book that's ever written. What we're going to do here is we're going to say we want to learn a representation of asset embeddings from some particular source. The question then becomes, what data is very natural data to learn representations of assets? Well, we're going to lean heavily on these analogies from the natural language processing literature. Just like documents organize words in language modeling, or images organize pixels in computer vision, or songs organize notes in audio, in financial markets, what do we have? We have investors that form portfolios in order to organize assets. Right? An investor goes out there, they pick the extensive margin of stocks that they're going to hold. They put stocks in certain positions in that portfolio, which gives some meaning to these underlying assets. So what are we going to do? We're going to lean on that analogy and we're going to say, how can we actually learn representations of assets from investors' portfolios? In the paper, we have a theoretical model that shows effectively what we're doing here is inverting the asset demand system. So you can imagine that investors have demand for assets. They choose the assets that they put into their portfolios as a function of some characteristics. Those may be our standard observable characteristics, or they may be latent things that we don't directly observe that easily, like subscriber growth for Netflix or exposure to COVID. Right? But when investors form their portfolios, they are using these characteristics. We show that effectively what you can do is you can invert the observed asset demand system to uncover the characteristics that investors use when they form their portfolios. The question then becomes, which method do we use? A big part of this paper is leaning very heavily on this analogy between the natural language processing literature and what we can do with investor portfolios. The natural language processing literature started off with what's known as latent semantic analysis. This goes way back to the 1980s and early 1990s. What was the idea there with words? What we would do is we would take documents, which organize words, and we would build document word count matrices. And we would take principal components of those, and we would extract representations of words based upon how much they were used in similar documents. Okay? We didn't stop there in the natural language processing literature. We went way beyond that. The first step was to build kind of shallow neural network-based models that learn word embeddings, but using neural networks. This goes back to the models of Glove and Word2Vec. Now, all of the early literature that built word embeddings built what was called context invariant embeddings. What do I mean by that? You could have an embedding for the word apple. And if you think about the word apple, if I use it in a sentence with the word orange, it has a very different meaning than a sentence with the word Microsoft, right? You can see where I'm going with that. Similarly, if I put apple into a portfolio, it might have a very different meaning if it's a portfolio with a bunch of tech stocks versus a portfolio with a bunch of large stocks. Right? And so we want contextualized embeddings, right? We want Apple to have a different meaning when it's in a portfolio with tech stocks than a bunch of large cap stocks. This is where transformer-based models like BERT and GPT come in. Those give you contextualized embeddings. Now, importantly, the parameters of these models are trained with what's known as masked language modeling. What's the idea there? You mask words in example sentences, and you train the model to guess the word that it doesn't know is in a given sentence. We lean on that analogy in this paper to show how we can use investor portfolios to learn embeddings. All right, even though our focus here is on asset embeddings, along the way, we actually recover investor embeddings. These are investors' preferences or taste for characteristics. These are very useful to think about representing investors. And again, we learn them from the portfolios of the investors themselves. Lots of applications here, classifying investors beyond institutional type, size, identifying crowded trades, or performance measurement. All right, the methods that we actually use in this paper, and I'm not going to go too much into detail here because it's a 20-minute talk. We use recommender systems, which is very close to the principal components analysis that I was mentioning with that stuff. We're also going to use word-to-vec, which is a locally nonlinear model, a shallow neural network. And then we actually show how to adapt the model machinery from the original BERT paper to learn asset embeddings from portfolio holdings data. Let me just show you how we adapt the idea of masked language modeling to investors' portfolios. What we need to do is we need to give lots of training examples to these models in order for them to learn representations of assets from investor portfolios. Well, so when we do this with sentences, what do? We take a sentence and we say a particular word is masked out. We do the same thing with investor portfolios. We take an investor's portfolio and we turn it into a sentence. One natural way to do that is to just rank the stocks in that portfolio from the largest weight to the smallest weight. It's not the only way you could necessarily form that sentence, but it's a natural one to start with. Here's ARKK's portfolio, the ARK ETF, in 2023. And here's our sentence for ARKK. The first word is the asset, Tesla, followed by Coinbase, Roku, and Zoom is in the fourth position. How do we do this as a training example? We mask the stock that is in the fourth position, and we train models, we have models learn a set of embeddings that can predict that this stock in the fourth position is Zoom, given all of the stocks in the rest of the portfolio. Those embeddings that we learn from that method give us some representations of those assets based upon how investors hold those portfolios. Of course, we do this with 10,000 different investor portfolios. We mask different positions so that we have enough data to actually learn a good representation of the assets. All right, we need to compare the embeddings that we learn from the holdings data to other different sources. We're going to use observed characteristics. We're going to use kind of just the standard 6 characteristics that we have here as a starting point. And market cap, book to market, asset growth, profitability, beta, and momentum. We've got holdings-based embeddings. And then we're just going to use basic text embeddings. These are single point in time embeddings. I should contrast that with what Bryan was doing with the news. These would be embeddings that represent Apple according to Cohere and OpenAI. This is very different than what Bryan is doing with time varying news in the sense that we're saying here, how does OpenAI represent just Apple Inc.? Okay. We're going to compare holdings-based embeddings to characteristics and this simple text embeddings across 3 different benchmarks that we think we should care about. One is predicting relative valuations. So I should note that all of the benchmarks that we build in this paper are cross-sectional in nature. We're not doing anything in the time series. We're just saying, given a single cross-section at a point in time, I want to build an out-of-sample benchmark that lets me see how well our embeddings represent that particular asset. So the first cross-sectional benchmark will be to predict relative valuations given a single cross-section at a point in time. We want to residualize out just the pure effect of size. So what do? We regress log market cap on log book equity, and we get this valuation residual, right? Variation in the price that's not just related to book equity. And then what we do is in every single cross-section, so each time period, we leave 20% of the sample out. In sample, we estimate a model where we look at the valuation residuals. We explain them with a set of embeddings. That could be characteristics, the learned holdings-based embeddings, or text-based embeddings. And then we evaluate the out-of-sample R-squared in that given cross-section. What I'm going to report to you is over our entire sample, the average R-squared across the 20 years that we study this in. We could also think about explaining co-movement, right? We can explain co-movement with daily returns over a given quarter or a given month. It's very similar exercise here, but instead of explaining the valuation residual, we end up explaining the returns on these stocks. Again, 80-20 split there. Estimate this model here on the in-sample 80%, where the characteristics or the embeddings our loadings on the factors, and then we evaluate that model out of sample in R-squared. The last thing that we could do is go directly at this idea that we want to understand investors' portfolios. Right? A natural thing to ask would be, can we explain, for example, what is the stock in the second position of a given investor? Right? If I told you all of the stocks that a given investor holds, except for the second stock, could you tell me what stock is in position 2? This tells us, do these embeddings or these characteristics represent how investors care about stocks? Okay. When we do that, when I train the actual embeddings there, I actually leave 10% of the investors out entirely in terms of learning those embeddings. So it is out of sample as well. All right. I'm going to show you some results and then a little bit of interpretability. So we've got 4 different models, what are recommender systems. You can think of these as basically PCA-based embeddings. We take the holdings or various transformations of them, just a binary for the intensive or extensive margin, or the extensive margin, and we do PCA on those. Those are those recommender system-based models. We're comparing this just to 4 characteristics because I'm explaining valuation residuals, so I have to leave market cap and market to book out there. So the base dimension in this particular case is 4-dimensional. All of the base models are also 4-dimensional. You can see that the various holdings-based embeddings over here do quite a good job in terms of R-squared out of sample in terms of explaining these valuation residuals. Similarly, the word-Deveck-based model does quite well in terms of 30% versus this basis of 4 characteristics at about 15%. We have a placebo on all these just so that you know that it's a reasonable test. Those are randomly generated embeddings. Large is not particularly large. It's just 10-dimensional in terms of embeddings, but larger models do better. It's not a fair comparison between the green and the red bars, though, because it's 10 versus 4-dimensional. We can combine embeddings in this standard basis of like 6 characteristics that we have. Adding the characteristics to the embeddings does not particularly improve the benchmark. They seem to incorporate similar information. What about the text-based embeddings? Again, this is just a representation of how OpenAI says they represent Apple Inc. at a given point in time. These ones don't work particularly well in terms of explaining the valuation residuals. Why is that? If you look, for example, at that representation of just Apple Inc. at a given point in time, the closest firms in that embedding space are ones like Appian, because they both start with APP. Those particular embeddings mix semantic and economic meaning. There's much scope for improving text-based embeddings, for example, like Bryan did, in terms of getting better representations there. Okay. Higher dimensional embedding models from the holdings also work even better. I'm showing you the transformer-based embeddings from our BERT-based model and our recommender system-based embeddings. Those go upwards of 70% out of sample in terms of explaining these valuation residuals. What about explaining co-movement? So this is explaining co-movement and returns. These 6 characteristics, standard characteristics that I chose, are a very difficult basis of characteristics to beat because they were selected explicitly to explain co-movement in stocks over a very long period of time. They have an R-squared of over 5% on the daily returns in this sample. Perfect. Our recommender systems from holdings data, even at 6 dimensions, they do okay. You can combine the characteristics and our holdings-based embeddings to improve the performance there. But you can also go to higher dimensional holdings-based embeddings. Once we go to higher dimensional holdings-based embeddings models, we can get upwards of 7% R-squared in terms of explaining the co-movement in this. These work particularly well, and the interesting thing for us is these are entirely learned off of the holdings data. They're not pre-specified to explain the co-movement and the actual returns. What about trying to explain what stock is in position 2 for a given investor if I told you the rest of the portfolio? Characteristics do reasonably well here. You can get about an 18% R-squared from that basis of characteristics. Our recommender systems here have a similar performance from learned holdings-based embeddings. The word-Deveck model goes upwards of 25%. That model is specifically trained to try to predict a missing asset. It's trained for masked language modeling, in this case, masked asset modeling. Right? So that model does quite well. What about the transformer-based model? That model builds contextualized embeddings. It's a high-dimensional model, and the entire task for that model is to try to predict what assets are in missing positions. That model out of sample has over a 60% R squared. This model is incredibly good at telling you what stock a given investor is going to hold, conditional on knowing the rest of the portfolio. All right. In the last few minutes here, I want to go to interpretability. We take holdings data and we learn representations of assets from that holdings data. A natural question is, if you're learning these representations of assets, what does that learned representation uncover about those actual assets or the investors for the investor embeddings? So what we're going to do is we're going to go towards, I would say, a multimodal approach here. We're going to bring in some text data. In particular, we're going to bring in earnings calls and investor prospectuses. Okay, and then we're going to say, I'm going to take the learned representations of the assets or the investor embeddings, the learned representations of the investors, and I'm going to find the nearest set of, say, 10 investors or 10 stocks or 10 assets. And I'm going to ask an LLM, what is in common about these 10 assets or these 10 investors? And we're going to see if these representations that we learn from the holdings data uncover some of these things that I was suggesting at the beginning that traditional characteristics don't. I'm going to take Apple here, and I'll take the 10 firms that are most similar to Apple in the holdings embeddings space. And then I'm going to use the earnings calls of all these companies, and I'm going to say what's in common between all of these 10 firms that are very close to Apple in the holdings embedding space. The model comes out and it says, market leadership and dominant positioning, position for major secular growth trends, financial strength and resilience, strong customer loyalty and ecosystems. To me, that looks a lot like the type of things that Apple actually has in terms of a representation of Apple as a company. We can do the same thing on the investor side. Okay, so on the investor side, I'll take investor embeddings that we learn and find the 10 investors that are closest to DFA's small cap value fund. And then I'm going to take the investor prospectuses and see what's in common across those. Focus on small cap companies, value investing philosophy, use of specific valuation metrics, so on and so forth. Very natural things that are these dimensions that our holdings-based investor embeddings are capturing. You can do the same thing with AQR's arbitrage fund, event-driven investing, arbitrage, fundamental analysis, long-short positions. All right, so I'm running out of time here. We've put up a website that lets you explore the holdings data for a given investor. You can find the similar investor in the investor embedding space. And it also lets you explore exactly what I showed you here in terms of interpreting what investors' portfolios actually represent in terms of these kind of underlying latent characteristics. You can go there. You do need to sign up because we use LLMs, so it can't just make it a free for all there. You can sign up, play around with it. We think it's kind of fun and interesting. So what did I do here? Recent advances in AI and ML can be applied to economics and finance via this idea of asset embeddings that has existed, of course, out there. We use characteristics for all kinds of representations. Our point here is we want to learn those representations, and we want to learn those representations from investor portfolio holdings data. They're the ones that use particular information to form their portfolios and eventually form the prices, right? So this information that we learn from investor portfolios can allow us to better understand the characteristics that matter for prices. In the paper, we have a micro foundation for why holdings data is natural. I showed how to adjust the methods from the natural language processing literature to apply to quantitative portfolio holdings data. We have another paper on fixed income that does the same thing with fixed income instead of equities. Thanks a lot.
Thanks a lot for the invitation. Thanks everybody for being here. This is joint work with Viral, Margaret, and Venki, who's over here. I want to shift our attention to inflation and inflation uncertainty. When I started with my PhD here at Stern in 2017, inflation wasn't on my mind. I think nor was it on anybody's mind, really, right? If you had asked me back in 2017 what inflation is going to be like over the next year, I would have said like, well, I guess it's going to be around 2%. If you ask me nowadays, I'm pretty uncertain, right? I don't really know what the future is going to bring. I'm not very sure where we're going to end up in terms of inflation. Well, why is that? Well, times are pretty different these days, right? We have, for example, the Iran war. There are a lot of different news coming out. Is there a deal? Is there no deal? Is there a deal? Is there no deal? So on the left-hand side, you can see the inflation expectations. Inflation expectations have risen, right? So have oil prices. But they have risen not that much, actually. If you look on the right-hand side, we're plotting here volatility, commodity price volatility. We're very uncertain about what the price of oil is going to look like 3 months, 1 year from now, right? And you would think that that overall commodity inflation, that is also what you ultimately see in consumer prices. So right now, we're pretty uncertain about what inflation is going to be over the next year. So why is inflation uncertainty important? Well, you think it's important for investors. Number one, when you form your portfolio, you have to decide between real assets, nominal assets. If inflation is very variable, you might want to shift your attention to real assets, real estate that are pretty stable in value. It's also important for household and firm decisions, and it's important for the Fed. The main goal of the Fed, or one of the two goals of the Fed, is to maintain price stability, right? To keep prices stable. So inflation uncertainty, if you have a lot of inflation uncertainty and people are not very certain what future prices are going to look like, you could say, well, the Fed is not really doing its job, right? There's some de-anchoring in inflation expectations, and the Fed is very worried about that. Yet, despite this being seemingly important, we know quite little about, first of all, how does inflation uncertainty look like over time, and what are its causes and consequences. Why is that? Well, we have a lack of data, right? So we had essentially inflation options that were trading. So these were options directly on inflation. They were trading for a few years from 2010 to 2016, but they're no longer trading, right? Our interpretation is that capital regulation essentially shut down this market. Now, the alternative measures that we have, we can ask people, we can ask, professional forecasters on what they think inflation uncertainty is going to look like in the future. However, it's not very easy to elicit the uncertainty, right? So, textual data and AI here provides an opportunity for us to essentially improve our measurement of inflation uncertainty. And through that, we can then study its causes and consequences, right? So we are essentially creating a novel measure of inflation uncertainty, what we're going to call like composite inflation uncertainty, or CIU. And for that, we're going to rely heavily on textual information. So we're going to construct a news-based measure as well as a market-based measure. Our measurement approach will allow us to have a pretty long time series starting in 1926. And that essentially allows us to trace out the implication and the causes of inflation uncertainty. Right? So we find that when inflation uncertainty rises, that means that the prices of real assets, so think about this as commodities and real estate, that those prices rise. On the contrary side, investors seem to shun nominal assets, those prices decline. Right? And then we also find that higher inflation uncertainty is associated with lower investment and lower economic output. So households and firms seem to hold back when they are very uncertain about future prices. Finally, we study the drivers of inflation uncertainty. We find that it's mostly, or it's to a large, over a large part of the sample, there's a lot of uncertainty about supply that's driving inflation as well as monetary policy. It has shifted in more recent years where trade policy, fiscal policy play important roles too. Okay, so how do we do this? Let me start with a news-based inflation uncertainty measure. The idea is essentially, let's just look at the newspaper articles and let's try to summarize how journalists think about inflation uncertainty at a given point in time. Right, so we have the business and economics articles from the New York Times. We have 500,000 articles between 1980 and 2025. Right, so our strategy is just to use our large language models to analyze these articles. So we are kind of old school. We are still relying on the API here. We're feeding in the articles and we ask it a simple prompt. Can you read the article? Then we ask, is this article related to inflation uncertainty? And if it is, can you quantify how large the inflation uncertainty is according to the article? How stable or how uncertain are you about inflation according to the article? And if this article is related to inflation uncertainty, also tell us about the factors that the article is talking about. We're going to then use the information or the feedback that we get from ChatGPT on all these articles to construct two news-based measures. Number one is a count measure, and number two is an intensity measure. The count measure is simply counting the fraction of articles that are flagged as being related to inflation uncertainty. Right? So the naive way we have been doing these essentially uncertainty measures is just counting words. So you count all the articles in which there's inflation and uncertainty appearing, and that gives you also a more naive-based version. Right? That's essentially the pretty famous Baker-Bloom-Davis economic policy uncertainty index. That's how they construct this index. Now you'd think that AI provides a lot more information. You don't have to rely on these. Okay, I think I'm going over here. You'd think that there's much better ways to do this, right? So that's why we're relying on the LLM here. Second, we want to also construct this intensity measure where we are just averaging the intensity scores across all these articles. And then finally, we can construct our news-based measure as the average of the two, the LLM count and the LLM intensity measure. So here's how this looks like. Here's the LLM count on the left-hand side. Here's the LLM intensity measure on the right-hand side. You see that in terms of the count, around 10 to 20% in the early part of the sample, 1980, that's when inflation was pretty high, are flagged as being related to inflation uncertainty. The naive-based count does much worse. It doesn't really identify many articles as being related to inflation uncertainty. You see that this is also consistent with the level of inflation being lower. You saw a period of where very little articles are flagged as being related to inflation uncertainty between 2000 and 2020. Then COVID happened. We saw this huge spike in inflation, and we see a lot of articles talking about inflation uncertainty. Now, the intensity measure that we developed shows a similar pattern. In particular, it also spikes here in the post-COVID period. Great, thank you. So, you might worry that, this AI is somewhat of a black box. We can't really trust it, right? And so we went on to compare the AI-based scores that we're getting, the LLM intensity-based scores, against human scores. Okay, so we gave the same, we can't give the 500,000 articles to humans. I think that's simply infeasible, but we can give a subset. So we tried this with 155 articles. We gave 155 articles to 5 humans, 3 RAs, 2 authors, and they all independently rated each article. So, the good news for us is that AI didn't really outperform us, but the bad news is it kept up pretty well. So it kind of performed like an average human. So here is essentially the human average intensity score and the ChatGPT score, and they're pretty similar here, 70% correlation. So essentially what AI allows us is not better than the humans, but it just allows us to implement this at scale. We can do it for 500,000 articles. The second validation that we did was we tried to compare it to survey uncertainty measures, right? These measures are not available for the entire time series, but they're available for a short period of time. So for example, the survey of consumer expectations from the New York Fed also tries to elicit inflation uncertainty. Same as the survey of professional forecasters. So we run here regressions, and you can see that our measure, the NIU, is pretty correlated with these survey-based uncertainties, pretty high R-squared when we run this predictive regressions. It's pretty interesting that the LLM intensity and the LLM count measure are much closer related to survey-based uncertainty measures than this naive count measure, right? So the naive count measure doesn't really do a good job. Okay, the second input that we need to study the consequences of inflation uncertainty, we're going to get from market-based prices. I told you that the inflation options are no longer traded, so we want to take an alternative approach. In particular, the ETF trading has essentially exploded, and there are many ETFs nowadays that hold bonds, treasuries, and tips, and also the options that on these ETFs, that volume has also surged in recent years, right? So we're going to focus on 2 specific ETFs here. One ETF that holds nominal bonds, treasuries, and one ETF that holds real bonds, tips. Both of them are available since 2010. And for both of these ETFs, we're going to get essentially the option prices and the option implied volatilities. We are also using commodity options and futures. There's a direct relationship between consumer prices and commodities that just allows us to go further back in time. So here is one slide of math. Bear with me. I'm going to walk you through this. I hope everybody in the room will understand this. So we're starting essentially with the option price the option price volatility for all these bond ETFs. Okay, so this is the volatility of the bond ETF price moves over time. Now we're not interested in the price volatility, but we're interested in the yield volatility. How much are yields of treasuries and real bonds moving over time? So we are scaling by duration. This is simple bond math. I'm going to go from prices to yields. So over here, I have essentially the volatility of real yields. On the right-hand side, I have the volatility of nominal yields. Okay. Now, essentially, we know that the difference between nominal yields and real yields is inflation, right? So you have a real rate that you're going to get, and then there's an inflation expectation on top. That's the nominal rate, right? So now we can just take, simple variances of both sides, and we're going to get that the inflation volatility is equal to the nominal yield volatility plus the real volatility minus a covariance term. So why does this make sense? So think of inflation as the difference between nominal yields and real yields, right? Now, if the top piece becomes more volatile, that means essentially that the gap between the two becomes more volatile, right? The gap now here is opening up, and I have more volatile inflation expectation. Same thing if you lower the real rates, right? If you lower real rate volatility, same thing. The gap opens up, and you have more volatile inflation expectations, right? Now, the correlation also matters. If both of them move in the same direction, the gap always stays constant. You have the same inflation volatility, right? Whereas if they are very independent, then inflation expectations essentially have moved a lot, right? So from nominal yield volatility and real yield volatility, we can back out implied inflation volatility. Okay, now we have to do one more step, because that will allow us to go further back in time. So for that, we're using commodity option volatility. So we're taking the first three principal components of all commodity price volatilities for 6 commodities: gold, silver, corn, soybean, oil, and natural gas. The advantage of that is that these commodity markets have been around for quite some time, so we can get more historical data. And then we run a simple predictive model where we're just predicting the inflation implied volatility observed in the ETFs. We're running a regression of where we're using the commodity volatility PCAs as the predictive variables and the inflation level, the CPI here as well, right? And that predictive model will give us our market-based inflation uncertainty measure. This is how it looks like over time. Our prediction R-squared is really good. There's a tight relationship between commodity volatility and bond ETF inflation volatility, as you would expect, right? So here, over this period, 2010, we have both the ETF vol as well as the commodity-based vol, and you see that the two lines really align, right? You see in particular here, this is the Iran war, there's this huge spike in inflation volatility. So here's how this looks like over the full time series starting in 1980, right? So you see that during stagflation period in 1980s, inflation uncertainty was very high, right? The level of inflation was very high. We were very uncertain about what inflation and future prices are going to look like. You have Q-rate invasion. Many of these spikes here are correlated with commodity price shocks. That's also what shows up as supply, a lot of this being driven by supply side factors. You have the Great Financial Crisis. Also during the Great Financial Crisis, we were very uncertain about future inflation. The US-China trade war here shows up. You have COVID and the Ukraine invasion. So very intuitive pattern. We extend that with additional data going back to 1900. Our measure becomes a little bit less precise because the data quality deteriorates as we go further back. Okay, with that measure at hand, we can essentially done some interesting analyses. Number one, we can compare it to other uncertainty measures, right? You might think that when we're generally uncertain about the macroeconomy, that might also be correlated with inflation uncertainty. That's what we find over here. So, we compare it, for example, with the VIX, we compare it with the MOVE. There is a lot of correlation, but there are also some distinct variation here. Inflation uncertainty behaves different to some degree, behaves different than all the other measures. So the R-squared from predicting our commodity inflation uncertainty with all the other variables are 46%, right? So a lot of independent variation. Inflation uncertainty really has, to some degree, a life on its own. So we want to understand what drives inflation uncertainty. Number one factor here that we are looking at is the level of inflation, right? You would think that if inflation has risen a lot or inflation is very high, we're uncertain. That's what we see here in this graph. So on the x-axis, you see the level of inflation. On the y-axis, you see the inflation uncertainty. When the level of inflation is high, we're generally more uncertain. When the level of inflation is generally low, we are less uncertain. There are a few here outlier dots where, essentially these are recessionary periods where the curve is shifted upwards. So in recessionary periods, inflation is often a bit lower, where there are shocks to consumer demand that potentially leads to lower prices, but we're very uncertain on what the consumer is going to do, and therefore inflation uncertainty is often high during those times as well. So we run a simple topic analysis using the LLM to dig deeper into this. So I already told you that for each article, we asked it about the factors driving inflation uncertainty, right? So we do a simple topic analysis with the LLM. We asked ChatGPT to come up with 10 topics covering all the factors. It comes up with topics like supply chain, production, energy and commodity prices, labor market wages, pretty intuitive topics. Once we have these 10 topics, we can essentially allocate, or we can ask it to allocate all the individual articles, all the individual factors to one of the 10 topics. And then we can collapse them ourselves into 5 broad topics. Topic 1 is demand. This is all factors related to economic growth and consumer demand. Supply, these are supply chain issues, energy prices or the labor market, monetary policy, fiscal and trade policy, as well as financial factors such as the stock market. So here's how this looks like in the time series. On the left, I started in 1980. Here on the right, this is really focusing on the post-COVID era. You see on the left here, supply factors are really the overall very dominant in driving inflation uncertainty. The other thing that shows up here as quite important is monetary policy. In particular, here in 1980s up to 2000, monetary policy was very important for inflation uncertainty. There's also a role for demand-based factors. We find pretty little role for fiscal policy and financial factors. Though it has shifted more recently if you look at the COVID era. So trade policy here became very important, pre-COVID. This is essentially US-China trade war that shows up. You have fiscal policy showing up here after the outbreak of the pandemic. Then, you have this huge spike in essentially there were early supply chain issues. So supply uncertainty was pretty high. Then the Fed came in and raised interest rates, or, it was argued that the Fed was behind the curve. The Fed maybe raised interest rates too slow. Overall monetary policy shows up as a main factor. And we're back to essentially trade policy over here. Okay, so the last analysis I want to show you is, does this matter? Does it matter whether inflation uncertainty is low or high? Should the Fed essentially be worried about inflation expectations becoming de-anchored and there's high inflation uncertainty? Well, Fisher and Modigliani in 1978, they already hypothesized increased uncertainty about future prices reduces the safety of nominal assets and increases the relative attractiveness of real assets as inflation hedges. Right? That's pretty intuitive. If you're very uncertain about future price levels, you probably want to shift into real assets. So we're going to analyze the contemporary relationship of CIU, or for inflation uncertainty measure, with the prices of nominal and real assets. So we're going to focus as real assets on gold spot, silver prices, Schiller Home Price Index, and nominal risk-free long-term bonds. Now, the one thing that I'm doing in this analysis that may look confusing in the end, I'm essentially using 1 divided by the price. So that's essentially the expected return that's a proxy for the expected return on all of these assets. So what we find over here is when inflation uncertainty is high, gold prices are high. So 1 divided by the gold price, that's low. So my expected return on gold is low. Investors have shifted into gold. That's why future returns are looking low. Right? Same for silver, same for house prices. We find that when inflation uncertainty is high, house prices are pretty high. The return that you expect on housing is going down. We find the opposite for the, most salient nominal asset, treasury bonds, right? Treasury bonds have essentially a promised coupon in nominal terms, but they're very risky if inflation is very high. Inflation uncertainty is very high, particularly. Right? So we find this relationship, risk-free rates essentially lose, or nominal bonds lose their value when inflation uncertainty goes up. Cool. We also do a similar study for corporate assets. We find that debt, as you would expect, loses its value. Equity prices, the relationship is not so clear. It's neither a real asset nor a nominal asset. Finally, we trace out the economic implications, and we find that when inflation uncertainty is high, generally there's lower investment and industrial activity. Okay, let me conclude here. We were constructing a novel measure that combines textual analysis of news articles and option price data. We built a long time series, and eventually we hope to make this public in real time. We provide an extensive validation with other proxies, and we think that more people should study inflation uncertainty. There are reasons to suspect that this has real and financial implications. And future research, there's a lot of future research that could be done here, potentially looking at other countries providing the same measure for the US, Eurozone, China, and so forth. Thank you.
All right. Hi, everyone. Thank you so much to the organizers for inviting me to present this new working paper.
Sorry for my long appendix.
Come on now. All right, here it is. So the paper is called Ex Machina, Financial Stability in the Age of AI. It's done with a wonderful group of co-authors, and because Kartik is at Bundesbank and Agnese is at the ECB, the usual disclaimer applies. So in this paper, we're not using AI as a tool. We're sort of studying it as a market participant. So at a very high level, what we're trying to answer is what happens if you swap out human investors and replace them with AI agents in a bank-run-like environment. I'm not going to shock anyone by saying that AI is transforming financial markets and has been doing so for quite some time and ramping up in the past couple of years. When I say AI, I mean different AI architectures. For example, reinforcement learning already dominates algorithmic trading, but reasoning-based AI, such as LLMs and LLM-driven agents, are also ramping up. You see more and more use cases within financial markets, so it's on the rise as well. And of course, people are taking notice, and I guess the big question that we want to know the answer to is, will AI pose a threat to financial stability? Now, that's a big question, and I feel like we don't even always agree on the definition of financial stability, right? So that's a tough one to answer. So we focus on a narrower, I guess, better defined question. And specifically, we ask, what happens to financial fragility when human investors are replaced with AI agents with different decision architectures? So how do we answer this question? We run a simulation-based experiment where we compare two distinct AI decision architectures in the same financial coordination problem. So our two types of agents are the Q-learners. So Q-learners are model-free agents that learn and solve the problem by trial and error, by just approaching it and doing this problem over and over again. This is a type of a reinforcement learning algorithm, one of the popular ones. And then we have LLM agents, so language-based agents that act through chain of thought reasoning and also drawing on the patterns they see in the training data. So these are our two types of agents, and we hold the environment fixed, we hold the payoffs and the choice set fixed, and we compare how those two agent types perform in this problem. So what is the problem exactly? Well, financial fragility expresses itself in many different ways, but it always hinges on two things. One is weak fundamentals, and the second one is panics. So on this graph, for example, you see that there is an area to the left where economic fundamentals are weak enough that you will get a crisis, a solvency crisis. And then the area on the right is where economic fundamentals are strong enough and no crisis occur. And then there's a gray area in the middle where outcomes depend on expectations, right? So that's the interesting part. And we felt like a mutual fund redemption game captures these aspects well. So this is what we're using in our setting. Right? Specifically, we're answering what happens if the investors in this coordination game problem are replaced by agents with different internal decision rules. Let me show you a bit more on our experimental setup. So we have a set of investors that are deciding whether to redeem or to stay in a mutual fund. If they redeem early, they receive a payoff of R1. If they decide to stay, their payoff depends on two things: economic uncertainty and what other investors choose to do. We initialize 30 investors, and we run this game for 3 rounds for LLMs, and we do 25 rounds of 500,000 episodes for Q learners, simply because this is how they learn. This is how they solve this problem. And we have 3 different treatments or arms. The first one is common knowledge of SATA. So everyone knows that everyone knows that everyone knows about economic fundamentals. And we also have default risk. So with some probability, there is a chance that the fund will fail in period 2. Second treatment is common knowledge of SATA and no default risk. So in second period, you get your payoff with certainty. And then the third treatment is default risk and fundamental uncertainty. So no more common knowledge of SATA, and each investor receives a noisy private signal about SATA. Okay, let's look at how our agents did in this setup. So first of all, let's look at our Q learners. On this graph here, you have the value of SATA on the x-axis and the share of redemptions on the y-axis, and you have the performance of Q learners in green and LLMs in blue. So what we notice for Q learners is that they over-redeem. So they keep redeeming even after it doesn't make economic sense. So we solve for the level of SATA where it doesn't make sense to redeem anymore, which is the dashed red line, right? And we see that Q learners coordinate on over-redeeming. We think that this is due to the so-called hot stove effect. So when Q learners start to play our game, they notice that when they choose to stay, sometimes their payoff is 0, right? Sometimes the fund fails and the payoff is 0. And they essentially learn that staying perhaps is not a good idea. So they never get to see the staying payoff properly. And this learning bias is never corrected, right? So we draw parallel here with literature on algorithmic collusion, where you have agents arriving at super competitive outcomes, but in our case, the agents are actually getting lower payoff action because of this bias. We double check, right? We sort of do a mechanism check here where we remove default risk, or just test the second arm, right? Where we don't have default risk. And the result for that run is drafted in black, right? So in black, you can see Q learners without default risk. So in this case, we see that QLs get closer to first best, right? So this essentially shows us that this bias is activated by the default risk or payoff stochasticity and limited exploration of the space. So a bias, but fixable. to some extent. Now let's look at how our LLM-driven agents did. So LLMs do not learn by trial and error, although they probably could be set up in that way. But LLMs reason about the problem at hand. The first thing that we notice is that default risk does not affect LLM behavior at all. They manage to reason in expected value terms and treat this as irrelevant. So they're smart enough to understand that. But what we found interesting is that they face a different challenge. In the area of the problem where there is a theoretical indeterminacy, they actually replicate this via belief heterogeneity. And what do I mean by belief heterogeneity? So because it's an LLM, we're able to extract the reasoning traces of the model and see how our LLM investors are reasoning through the setup. So we can see how they think about the problem at hand, the justification. We see how they arrive at specific beliefs about what other investors will do, looking at those justifications, and then through those beliefs arrive at a decision. Right, so you can see that agents initialized from the same model, temperature 0, same information at hand, simply because they choose or generate different justifications of the problem, they arrive at different outcomes, right? They do not manage to coordinate on one outcome. Some of them think like, someone who understands game theory, some of them think about payoff specifically, and some of them just, say that, well, it's impossible to know what others will do. And all of that leads to different beliefs. So that was quite an interesting thing to read. Yeah, and I mean, this sort of disagreement between investors is not random. It's present exactly in that area of SETA where multiple outcomes are possible, right? So as fundamentals improve, our investors realize that they don't really need to think about what others will do, right? That staying is the choice they should make. So how do we fix this one? Well, it's quite interesting. If we introduce strategic uncertainty, if instead of providing common knowledge of SETA, we give them sort of private noisy signal about SETA, they manage to use that as an anchor, right? And you can see that when they're anchored, you can see this line in red. They converge on a first best in a one-shot setting. So no training, nothing from the first attempt. If we change information design in this setting, then this problem is solved. So we think this happens because the signal provides a specific anchor for them, for their reasoning. So instead of thinking, well, maybe, some investors will do this, some investors will do that, they think more like, well, I got a private noisy signal, so I'm going to use a specific cutoff rule for my decision. And, others got the same kind of, not the same, but the private noisy signal, and they'll probably follow the same strategy. So it allows them not to kind of overthink, I guess, right? So we can also see that convergence in the reasoning traces. So this is the private signal setup. So to conclude, it's a fairly simple paper, but we really did find the behavior of these agents and the biases and the issues fascinating. We argue that both AI architectures pose novel threats to financial stability. We find that Q learning agents coordinate on privately harmful outcomes and systematic over-redemption. Their learning is distorted by default risk. LLMs generate belief heterogeneity under common knowledge, but this gets resolved by information design. Of course, we're not claiming that these types of architectures are used in specific settings. The point is more broad. We need to study different architectures in different settings to understand them as people start to use these models, and especially autonomous agents, more and more. This will become more relevant. So that's to conclude. Thank you so much. Happy to.
Okay. Well, thank you all for your great talks. Maybe we can start by one thing that I observed sort of between all of your papers is sort of a common thread. But it's a thread that was actually expressed very differently in each of these papers. And the idea was that you wanted to have some sort of form of understanding and explainability in the outcome and the result from the large language model. And the thing that I thought was really interesting is that each of you took a very different approach to it. Right? From, one approach was to look at it more mechanistically, like you did, Bryan, with like the sparse autoencoders, which you didn't get much chance to talk about, to what you did, Sophia, in terms of looking at reasoning traces. And so one of the things that I think is interesting and challenging in this area of research is this idea behind actually looking at the explanation that you get when you're doing this kind of research. And, one of the things that I wanted to have all of your opinions on is basically like this idea of, okay, how do we get at what the model is thinking or how the model is behaving, given that we have this, high dimensional feature space that we eventually want to, compress down into something that is, human understandable in one or another method, whether it be faithful or not necessarily faithful. So do you want to get us started?
No, I agree. I mean, to some degree, it's a black box model, right? It has a billion of parameters. Like we have to understand this, and we have to look at the outcome and eventually evaluate the outcome against some other benchmarks that we can potentially understand, and then see how close does it get to what we know, what we can understand, and then maybe that's the first step for us.
Yeah, we took one pass at it in terms of interpreting the investor and asset embeddings, but we're all, those embeddings could be much larger than we're even representing. And I think we're only capturing kind of a small subset of the variation that's actually there, right? It's the variation that is with respect to similar firms. And, then we only look at 10 or so of them there. And so I would imagine there's a lot more there, right? And so for interpretability, we have to kind of collapse things down. But once we collapse these things down, we're not capturing the full richness of these things. I mean, Bryan has a lot of work on complexity in these things. And I think there's a lot of dimensions that matter in financial markets. So, we can collapse down to corners of these things, but it's not clear that we're necessarily going to be able to always explain everything.
Yeah, I'm not sure you're getting a representative sample of the economics profession here, because Rob's view sounds sort of aligned with my view. And I would not think of this as the typical economics view, which is sort of a, I don't know, dogmatic crusade for interpretability and explainability. I think the economics profession has multiple roles, right? I think some of the roles of the economics profession are pure measurement. If we can measure, and when I say measure, I'm really thinking about in the form of prediction, we can measure better, then we can arm economic actors, be they investors, the regulators, consumers, to make better decisions, then we're doing our jobs as economists, right? So part of our job is understanding, right? Understanding the science of the system that we're trying to explain, this economy. But part of our jobs is that we are a practical discipline. And if I can build a model that's very successful in prediction, and very difficult to explain or interpret can still be massively valuable to society. And so I think that's a view that I've been trying to express quite often in my work recently, and this is what Rob is alluding to. But I also think that it's not always the view that you hear out of economists. So I guess I just want to make sure that view is articulated and appreciated.
That's a very good point. I guess I'm coming from a more dogmatic side of the profession. I mean, I think if we're using LLMs for measurement, we do need to be able to validate them to some extent, and it's not always possible. So even if they're producing something very valuable, how do we know that there isn't a catch hidden in there? How do we know that their behavior or performance is going to be stable? I guess we would introduce some continuous monitoring frameworks if the use case is a high stakes setting, but it's a very hard problem.
Thank you. I think before I open it up to the audience, I'll ask just one more question. So Bryan, in your almost at the very end, you talked about the point-in-time models, and many of you looked at different models, right? And I think one of the things that comes up in my research, and it comes up in research in general, especially on these AI systems, is basically like durability of finding. Bryan, like you said, there's a whole bunch of people who are like, oh, this point in time problem is really a big deal, is really very interested in seeing that actually the point in time problem is not as big of a deal as I had expected, right? So I was curious about your opinion just in general in this research field as we, continue, and we have ChatGPT 5.5 that came out today, and the reasoning models continue to change. What do you think about the durability of, these kind of methods sort of moving as we change? Sophia, do you want to start?
Sure. I mean, if we're thinking about this purely from like reproducibility point of view, then open weight models, I guess, are the answer, because that's the only guarantee that your result will replicate. You don't really know what the companies are doing behind the hood. So you might be using GPT-4o, but it doesn't mean that that's the same model that was there 3 months ago. So the labs are constantly tinkering with the models. And then, they can make arbitrary choices to retire them and so on. So if we're looking at this purely from academic perspective, then open weight models that, let's say, even local models that you can download and have right on you, that's the way to go. In terms of how performance of these things progresses, I mean, I guess this is something that we'll have to study continuously, right? Because there's a kind of a huge progress taking place. So anyway,
So durability is tricky, right? I mean, on one hand, I don't envy people that are training as PhD students right now because the ground is constantly moving underneath them. But on the other hand, I'm massively envious of PhD students now because they're being trained in one of the most exciting times that I've been a researcher. So we just need to learn how to live with this, right? I think we're all learning in real time. In terms of the point in time aspect of what we did, I think it's interesting. I think point in time language models are very important for certain types of questions, but it's not totally shocking that in the application that I had, a point in time language model didn't make a difference because the objective function of the application I had was massively divergent from the objective function that these models were trained on. And we know that when we worry about things like overfit is most severe in the directions that align with the objective function. So that's not totally surprising, but I also think that it's a sort of a soundbite that gets lost in the point in time pounding of the table. And so I was glad to see that it played out the way it did, and I just think it adds more texture to this discussion about what is leakage, how big of a problem is it? it's probably not that big of a problem in these types of environments where you're, you know, trying to translate things into return prediction, right?
Yeah, I mean, I guess I would echo Bryan. I think that language about these models having a lot of hindsight bias in them, it depends on how you use them. You know, if you go ask GPT 5.5 right now to, you know, specifically give you a point in time forecast looking backwards of returns, you're not going to have any idea whether that is actually using the prior knowledge or not. But there's ways to improve that, right? You give the models tasks like embed the news, and it's going to focus on just embedding that news, and you're not going to have a lot of forward-looking bias out of something like that, if much at all, right? So I think it's how you use the models that matters a lot for whether these things are issues or not.
I fully agree. I mean, it depends whether the LLM can essentially infer your objective function, right? If you ask it to predict the stock return over the next month for a given stock, I mean, then it can just look into the historical news and back it out, right? But if you're measuring something else and the LLM doesn't really know what your objective function is, I mean, how would it infer that, you know, based on the historical information that is available to it? It seems like that's not feasible. So I guess it depends. So it depends very much on the application.